Thank you for being here. We have an amazing panel with Beezer and Margo and Max, who not only are industry leaders, but also sit in have different perspectives as LPs in the industry. Our panel, I think everybody's thinking about the down market, what's going on, what's going to happen, how are you guys thinking about it? So maybe I can ask you each to, starting with you, Beezer, quickly introduce yourselves, your firm, and what you're investing in, what venture looks like in your portfolio today.
Sure. So first of all, thank you for having us. It's really just an honor and a privilege to be part of the vintage community. I'm Beezer with Sapphire Partners. We are the LP strategy of Sapphire, which is a larger venture investment firm. We focus on early stage venture in US, Europe, and Israel. And we on the LP side just do early stage venture, so that's the simplest part that I have to answer.
Great. I'm Margo, and I'm the Chief Investment Officer for a single family office based out here in Menlo Park called S Cubed Capital. I've been there incredibly almost 9 years now. Prior to that, I was at Cambridge Associates. So I've had the pleasure of knowing a lot of you for a really long time. And importantly, just want to say thank you to Alden and the Vintage guys. Alden, in particular, has been a real dear friend and mentor for me, and I've appreciated that he's engaged in dialogues and discussions and debates on a myriad of topics, but importantly, this whole investment environment. And so I'm just grateful to finally be able to join you all here. With respect to our venture portfolio, the genesis of the capital of our family office is venture capital. Our principal was at Sequoia for a long time, running the firm and making investments there. And so one thing that I think differentiates us from some family offices is the idea of investing in venture and having the long duration and patience to understand the ups and the downs and the path that companies go through to hopefully be successful is something that we understand and we're willing to invest in. So we invest across all asset sectors, all asset classes, all geographies. Privates end up being about half of our portfolio in target. We're not quite there, so we're still building. And venture is about 50% of our privates.
Great. Well, I'll echo what everyone else has said. Thank you very much for having us, Jonathan and Alden. Obviously, great event, great group of attendees here. Max Miller, I am with the Canadian Pension Plan Investment Board. I've been with the organization about a decade. I'm Canadian originally, but I moved to San Francisco in 2019 when we decided to open an office out here and invest a lot more time and capital into venture and growth. We invest across basically all sectors and geographies. We're about a $400 billion plan. We have 10 offices around the world. The area that I focus on is venture and growth, fund, and direct investing. Today we have about a $5 billion program there, but we're looking to grow it over the next few years going forward. So excited to be here.
Thank you, guys. And Margo, building off of your comment, given that you and Max, your organizations are also focused on other assets outside of venture, what do you, for the whole panel, what are you looking for in a manager when you're doing your diligence? And then for you two who aren't only focused on venture, how do you think about time allocation in venture versus all of the other responsibilities that you have?
Well, when you first asked this, you said, what do we look for in venture? From any manager, we're looking for returns. Let's be honest. At the end of the day, we need performance, and hopefully I won't be retired and not here to see it. So always, the things that I think, when I tried to boil this down, it has to be differentiated capital. There's just so much capital out there looking to invest into companies that when we're meeting a manager, we have to understand why your capital is going to be attractive to the founder over somebody else's capital. And so that lets us start peeling the onion back on what do you, it's your organization, or if you're a solo GP, what do you bring that's going to be unique? It could help you with sourcing. It could help you with that value add that we've heard a ton about today. It could help you think about bringing customer relationships. Some firms are oriented around helping on the exits. So it's okay that the purpose for you can be varied, and we're not trying for everybody in our portfolio to bring exactly the same thing. So we're looking for those differences that stand out, and then that you can show us can be repeatable. And so, we're not at S Cubed. We're not big momentum investors. We didn't suffer from the FOMO, and I think that was helpful. Some of that came from having been in the industry for so long, and having that time duration that we can invest for the long period of time. I have other things in my portfolio that are meant to provide me with a more near-term liquidity. So my venture can be the engine that should have the higher returns over the long term.
Yeah, the only thing I'll add, we obviously focus on returns, and that's the number one objective for our organization. I think one of the unique elements about our program is that today venture is 1% of our total plan. And if we look at just our private equity group, it's only 4%. So we had to think about beyond just returns, how we can make it, because even if you on 1% generate a 10x return, it's not that meaningful for your program. So we had to really think about how else would venture benefit a broad, big, largely multi-asset organization like ourselves. And so for us, it's primarily two ways. It's number one, deal flow. So as we think about how venture can, those companies eventually become growth round companies, eventually become mature buyouts or go public or require credit or can work with our real estate team, there's a lot of opportunity that starts at the earliest stages of innovation. And second, and we call it radiate internally, is how do we take all the learnings from what we're picking up across the venture industry and apply it to the rest of our much bigger portfolio to make us better investors, either as we're entering new positions for the first time, managing our existing assets, or thinking about operationally how we implement some of that. So just one example, yesterday we have a large reinsurance company, and they're looking for and thinking about how AI can be implemented in their business, either for underwriting or for operationally. And so we're now looking in our network and have suggested an advisor for them to work with. And so this was a capability that prior to us really entering into venture, we likely would not have been able to do as easily. So.
Can I jump in?
Yeah.
So I have two thoughts. One is very tactical, and to the extent this is helpful, when we look at a venture fund, we underwrite Series A to a 3x net and seed to a 5x. And I just throw that out there because when people say, what do you look for? Like, all the same things they do, but and I'm sure they do this exercise too, but we've just set parameters for what we think needs to be possible when we look at a fund and its construction and its target areas they're investing in and that whole big, wonderful bucket. So that's the tactical. And the other thing that I've just been really struck by this fall in going to annual meetings and seeing, kind of hate the word durability, but managers that have continued to come back and to think through things, there's this aspect of, the colloquial term seems to be first principles, which I also kind of hate because it doesn't really mean anything to me. But what I've experienced is investors that really show up and say, like, why am I here? What am I doing? What do I believe in? And they invest based on this. And it really resonates differently when they speak, at least for me, for when I'm listening, than for folks that might be playing a slightly more momentum or market game. And it doesn't mean to say you can't have performance on both. But when I look at folks who've kind of gone through the up markets and kind of kept their head and are going through the down market and are managing, there just seems to be this nature of it, which has just been very present for me this fall. So I throw that out there because I do think people that think for themselves are by definition differentiated.
Yeah, it's so important because Sapphire obviously has such an amazing portfolio and a high reputation. For the crowd to imagine, what does a fund need to have to break that bar and actually get added to what you already have? It needs to be additive to what you've built. As we think about maybe reflection of where we've been, after the last financial crisis, we saw monetary easing, zero interest rate policy created probably the best investment environment for almost every asset classes in most of our lifetimes. And with that, we've also seen an enormous amount of capital raised, fund sizes ballooning, people kind of stretching beyond what their original core focus was. So Beezer, as you kind of building off what you said before, do you see structural changes happening in the venture industry, and how do you think about navigating that?
Structural meaning, did a lot of people raise a lot bigger funds faster? Yes.
Yeah, and also Alden talks about succession planning, not only the fund sizes ballooning, but moving away from core focus, maybe less about returning capital and more of how much money can we make, less about differentiated deal sourcing. So, what changes do you see happening as you talk to managers every day?
We definitely saw a lot of what you were talking about, which is people expanding strategies. And I'm going to quickly kick this can to you guys because you probably play in this space more than I do. Since we focus on early stage only, a lot of these strategies we experience in the market are not necessarily in our portfolio because it doesn't end up being a fit for us. But you see it, and it's clearly been impactful in the industry. So you do see folks adding different kinds of strategies or increasing fund size. I think it's great for the entrepreneur if there's more capital out there. I would just say, and then I'm going to again kick it to the experts to really actually talk about this, be conscious that it raises the level of, I would say, execution. Like you're kind of going off like the super high diving board in the Olympics, and like some folks can do that and it's amazing, but if I did that, it would not work. So like just be conscious it adds a lot of execution challenges.
So, and the execution you just referred to is fundraising for the GPs, right? So I think one of the things that did get lost in this last cycle from 2020 to 2022 was this pace of fundraising and the demands that the GPs had of the LP. And I think you've done a great job with your Open LP trying to get the GPs to be able to hear and understand what LPs are thinking about. I know we're often black boxes, but the reality is our portfolio construction for many of us is not just venture, it's across the entire platform. People have different demands of the capital they need to create. And so when our venture partners came and started adding on the co-investment and the growth funds, and then maybe geographically expanding, we started to have demands of our commitments that created dislocations in the cash flow streams we were projecting. And at the end of the day, our business has to create cash flows, just like you need to create returns and cash flows from your investments. And we go back to the duration piece. Everything was getting extended, and now we're all going to be extended again. So I don't think fundamentally investing has changed, but I think the number of companies that we were seeing go into our GP's portfolios, and therefore the number of demands on the partners to be able to keep track and to truly add that value to each of those companies was changing. And then you have these market and macro effects that are extending everything or that are changing the timeframes for the customer adoptions. And we've sort of come into a world where we have another perfect storm of challenges on you, the GPs, and the founders in building these companies. And we as LPs, at the end of the day, are constrained. I'm always envious of the family offices that have a phenomenal cash flowing business feeding their investment pools. We create our growth in our investment pool through our investments. So we don't have one of those cash flow engines kicking off quarterly inflows. And so I need to be in partnership with my investments.
Yeah, I mean, the only thing I'll add on that is, so in the period that was described, the 2020 to 2022 vintage, we saw a lot of this growth in the space. And I think if we look at our portfolio, 21 managers, probably 13 focus on early stage, and only one doesn't have an opportunities or growth fund at this point. So they all raise these later stage vehicles. For us, it was actually a positive at the time because we had been newer to venture. We didn't have the same sort of historical track record or exposure relationships that you both did. And so for us, it gave us an opportunity to actually create those relationships, be able to deploy scale checks, as well as work together on those growth rounds around direct deals alongside these partners. Fast forward to today, what we are seeing, and this is particularly true this quarter and then in Q1 of next year, is just now the decoupling of a lot of those funds. And so what's happened over the last period is that early stage has continued to be fairly active and fairly resilient to the broader economy, where growth has basically shut down for the large part. There's obviously exceptions, and AI is definitely one of those areas, and a few other places. But early stage has stayed active, and so now you're getting into the situations where these funds have their early stage funds, which are 80% called at this point or committed, and their growth funds, which are barely activated. And so you're getting this decoupling that's happening. And so that's kind of an interesting dynamic we're working through right now.
Are people still raising them as stapled though?
No, they're not.
Oh.
I mean, there's exceptions, as you probably know, but yeah, I mean, a lot are, which is also an interesting strategy because I think the perception through a lot of LPs is they really want that early stage exposure, and that's extremely valuable. And to get that, they would used to have to do growth, and now they're splitting them up. So I think when these growth funds come back next year, it'll be interesting to see how successful those fundraisers are, and if people kind of continue to back them when they've already received their early stage exposure from this year.
Well, and to be just a little critical, if I may, I think when we were watching the explosion of these co-investment pools, I go back to kind of why they were happening. And I think a lot of GPs came to me and said, I've handed over return and upside to my LPs with these SPVs, and they take a ton of my time. And I want to be able to back my companies. I was there early, I identified it. I have allocation that's not appropriate for my early stage strategy, but I don't want to lose out on it. And so I think there was a little bit of blurring as to why some of the firms raised the additional capital. And then you had to add people behind it because there were so many companies and the pressures on your firms grew. And so all of a sudden, we got to this phase where there was so much capital that you'd raised for it. It was mismatched. You know, some of our managers are kind of 5x the growth dollar to 1x the early stage dollar. And I think these are the things that are going to have to get unwound. I don't know what you're seeing, but most of our early stage managers that raised in 2023, they originally thought about bringing their opportunity, co-invest, what have you want to call it, fund alongside, and they've kicked that can down the road.
Can I ask another follow-up question?
Please.
When you see the,
I'm going to hand you the cards.
Okay, well, they're brilliant. So this is so much fun. When you see the dollars going in 1 to 5x, do the returns come back differently? Because we always question when another check's coming in later, and there's ways of constructing funds that make it perform. But a lot of times we wonder if those later checks are going to be as productive for the vehicle that they're in, which is a huge caveat, versus some of the earlier checks, and could that money have been used differently? But I don't have the numbers, so you have the numbers.
Go ahead and start if you want. I mean, you've seen it. You've
Yeah, I
been
mean,
through it.
it's a different return profile. I think they're targeting. So I think while early is, and it's also interesting because I also think it depends what you're because we said returns at the beginning, very like broad strokes, but we're largely an IRR-driven organization. And
Can you say why? Sorry, I'm so sorry.
Don't
But
apologize.
I think these are
great.
This is the value of getting Beezer.
Our prep beforehand was supposed to be bouncing.
yeah,
This is
yeah.
Sorry.
This is better than it could have gone, I think.
This is great. I do want to hear like Beezer's perspective on this out there. She can't get out of all the talking. I mean, we have alternatives as well, right, to invest that capital. And so IRR is the best way to trade off those alternatives and make a decision of why $1 should be going into venture versus a private equity type deal. And so that's why we think IRR is the best way to compare across that. And if it's and so that's why we looked at it. Now there's obviously flaws of focusing on IRR, such as the sustainability of some returns that have been generated and how reputable that is or repeatable that is, and you probably see that more in MOC. But that's how we look at it as an organization.
Max, maybe, or
Sorry, I
you
was
can also
just going to
answer.
add on that idea of the growth capital, though, was meant to have a shorter duration. And I think that's the big thing that didn't happen. If you sold, I know a few people who sold in Q4 of 2021, like, kudos to you. I wish I was you. I did not pull things off. Frankly, we couldn't pull things off. So we were watching these valuations thinking, wow, we're really good at this. And we thought those growth dollars were going to return for us, but now the durations have converged again with the earlier stage. So the good thing is for firms that are trying to get dollars to work, and this is where GPs, you've got to really understand what is the LP trying to accomplish that you've partnered with. For those that just need dollars at work, they might be a lot less concerned if their bigger check ends up only giving them a 2x return, even if it took a little bit longer, it'll hurt the IRR. But if it takes them 5 times as many early stage seed checks to get those same dollars at work, it takes even longer, and maybe the returns got a little bit capped here in this environment, and we're not going to get the 5 to 10x returns. And there's interesting data, and I know Cambridge is represented out here too, but go back and look at how many venture funds have exceeded a 3x net. It is not many. So I know we talk about looking for 5 to 10x returns, and there have been some firms, I think, especially when they have smaller size funds, who have been able to really generate those types of multiples. But we are really talking about over the full venture fund cycle, trying to get a net 3x return from these groups.
I know I sent my questions before, but you answered almost all of them. And I was going to ask you two specifically to think back on your portfolio and grade yourself on how you think you've done, and to think about, what you're paying attention to today that maybe you weren't 12, 24 months ago because of the issues that you had mentioned. So maybe you, Beezer, because those questions were answered.
This is payback, isn't it?
Yeah, it's not payback. It's a good question. What have you learned from some of your less good investments over the past couple of years, and what are you paying attention to in particular now that maybe you realize, I always knew that was important, but I actually maybe was underweighting it more than I should have been?
Well, I would say we always try to make the best decisions we can make with the information that we have. And as all investors know, that doesn't guarantee you success. So I just have empathy for all of us investors. We do the best that we can. I would say a question that I hear us talking about a lot, and I hear LPs in general, maybe this resonates for you guys, maybe you have other questions, is what is going on in the portfolio? And I am such a broken record on this, but in the fast and furious 2020, 2021, 2022, it was really hard to get all that information because what you had was a lot of top line, right? TVPI, companies were budgets were open at the large corporates, like there's all these lovely top line numbers, but it was hard to know what was really going on underneath. And now I don't think it was a question we didn't want to ask, it was just really difficult essentially to get a word in edgewise, given how the market was moving. And so now I go through every LPAC, I go to every annual meeting, and I just hear LPs being really thirsty for help me to understand the metrics in the firms and the companies, how are they doing, how are the people, what are the margins, like a lot of, sounds like really nitty gritty, but it's just trying to get a more of a nuance, and the world's correcting, we all know that. So like, let's just have a conversation about what it looks like, and we all know companies are gonna struggle, and some of them are gonna come out much better for it, and some won't, and let's just do it, so.
Yeah.
I think transparency. I used to say a lot of people want the revenues, the margins, these metrics, as long as the people asking for it are actually going to do something with that information. So be cautious of the people who just ask for it to fill in boxes. But when you're really trying, the only thing we can assess the high-level fund numbers you give us is to peel back a little bit. In the top-line days, we were looking at revenue growth, but we were looking at employee growth, all of that. But now you've done these RIFs, you've been protecting your cash. Tell us now what's changed with the strategy of the company that changes the hockey stick opportunity that you originally invested on, and what is therefore the potential outcome from this company, so that we can all be honest about what we're going to get back, so that we can be making real decisions on where we're pivoting our capital.
Yeah, I think I totally agree what Beezer and Margo said. I think DPI is probably the most talked about metric at the moment, and that's what everyone is focused on. And it's almost talked about so much that it's less of a differentiator at this point, but almost like a mandatory check the box. You need to talk about it when you're meeting with prospective LPs or at the LPAC. And I think a firm can differentiate itself by having a clear plan about what that means and how it is different than others that are out there. I think that's certainly one way. And then I think on the topic around transparency and acting, I think making those hard decisions quickly. I think people who may have been great investors in the 2020 to 2022 environment may not be the best investors today at a firm. And I think we really respect those firms that make those decisions around personnel and team faster than letting them drag on and really impact the culture of a firm over a longer period.
Can I say one more thing?
Please.
I think my concern is, and I just keep harping on this with folks, is that for an LP who's trying to make sure they don't lose capital, like it's really not a good idea if you're a fiduciary, like from an LP of someone else's capital, to be like, oh, so sorry, it's gone. So sorry, endowment, so sorry, hospital, like, so sorry.
Tough conversation.
Tough conversation. So there's some natural conservativeness in this, and so it's a very natural thing for LPs to pause when they're unclear of what's happening. and just say, I'm gonna wait 6 more months and see what happens, because eventually it'll become clear. And I just want GPs and fundraising in this market to go into this prepared to understand, so that that level of I just don't know at least is taken out of the room. People might pause anyway, but it's any information that you can, preserve in confidences but manage, this will help in the relationship building, and I just offer that out because I know this market is kind of crap. Sorry.